Welcome to the Pro Ticker Deep Dive.
It's great to be here.
Today is Tuesday, February 10th, 2026. And I have to say, looking at the screens this morning, the vibes are off.
That is putting it mildly. The vibes are arguably non-existent.
Yeah, really. If you checked your portfolio over your morning coffee, you might be feeling a little motion sick right now.
A lot motion sick.
We are waking up to a financial landscape that looks, drastically different from the one we closed out 2025 with.
It's a whole new world, it seems.
It does. You have silver and gold, which were the absolute darlings of the last year, practically printing money for people suddenly cratering.
It's falling off a cliff.
And then you look at the currency markets. The US dollar, the king dollar we all grew up with, is looking shaky. It's sliding into what looks terrifyingly like a bear market.
It really is the perfect storm. You have this massive volatility in commodities meeting a structural weakness in the currency. It's rare to see them move like this simultaneously.
And just to add insult to injury, while our portfolios are melting down and the dollar is sliding, we all have to sit down and file our 2025 taxes.
The fun part.
The really fun part. But we aren't just filing taxes, we are navigating the One Big Beautiful Bill Act, or OBBBA.
Which is a mouthful of an acronym for a massive, massive piece of legislation.
It really is. So the mission for this deep dive is pretty clear. We aren't just going to recap the news because anyone can read a headline. We need to build a survival guide.
That's the goal.
Because reading through the research stack you brought today, the macro analysis, the tax code breakdown, it feels like the era of U.S. exceptionalism is fading. That feeling that U.S. markets can only go up and the dollar is the only currency that matters, that might be over.
I think that is the right framing. We are seeing a structural revaluation. This isn't just noise or a bad week of trading. You have the intersection of policy, that's the OBBBA tax changes meeting macroeconomics, with the Federal Reserve's aggressive rate cuts.
And the phrase I keep seeing in the notes is that the free lunch for U.S. dollar investors is officially over. That sounds ominous. But also, what does it actually mean? What free lunch have I been eating?
Well, you might not have realized you were eating it. But for the last 15 years, really, U.S. investors have had a massive tailwind.
A tailwind how?
You could simply hold U.S. assets, stocks, bonds, whatever, and because the dollar was strong and getting stronger relative to the euro or the yen, you didn't have to worry about currency risk. You were getting a premium just for showing up.
So even if my stock didn't move, the fact that I held it in dollars made me richer compared to a guy in Germany holding a German stock.
Exactly. You had the exorbitant privilege of the world's reserve currency working for you. But now the bill is coming due. We are entering a new cycle where that currency strength is becoming a weakness.
Okay, let's unpack this. We have to talk about this dollar bear market because it affects everything. Our purchasing power, our travel plans, our portfolios.
It touches it all.
The projections are showing a potential 10 to 15% drop against major peers. For the listener who isn't a Forex trader, why now? We've been hearing about the death of the dollar since the 1970s. It never happens. Why should I believe this time is different?
And that is the skepticism we need, because you're right, the dollar is incredibly resilient. But the drivers right now are fundamental, not just, sentiment-based.
Okay, so what's driver number one?
First, look at the Federal Reserve. We are deep in a rate-cutting cycle. The Fed is moving its target toward a neutral range of roughly 3.0% to 3.25%.
Okay, so interest rates are coming down. We've seen that happening.
Right. And you have to understand why foreign investors hold dollars. It's not just for safety. They want yield. For years, you could park money in U.S. treasuries and get 5%. You couldn't get that in Europe or Japan, where rates were 0 or even negative.
So the U.S. was the only game in town for safe returns.
Precisely. It was a simple trade. Buy dollars, buy U.S. bonds, collect your 5%, go to the beach. But as the Fed cuts rates, that yield, that juicy part of the trade evaporates. The premium is gone.
It's gone. As U.S. yields fall towards 3% and European yields are maybe at 2.5%, the difference isn't worth the risk anymore. That global capital starts looking for a new home. The incentive to hold dollars weakens.
So that's the monetary side. Less yield means less demand for dollars. But what about the government side? The fiscal side?
That's the second and perhaps scarier driver. The fiscal strategy has shifted under the new administration. The OBBBA tax bill, which we will get to in detail, is expensive. It is projected to increase deficits by about $2.8 trillion over the next decade.
2.8 trillion, that is a hard number to even visualize.
It's massive. And when you combine falling interest rates with ballooning deficits, international sentiment sours. It raises questions about fiscal discipline. Can the U.S. afford its debt? This creates the classic twin deficit problem.
I see this term in textbooks, but let's ELI 5 it. Twin deficits. Explain it like I'm 5.
Sure. Imagine a household. Deficit 1 is the budget deficit. You are spending way more money than you earn in your paycheck. You're living on credit cards.
Been there.
We all have. Deficit 2 is the trade deficit. You are buying way more stuff from Amazon importing goods than you are selling to your neighbors. You're not producing enough to pay for your consumption.
So I'm overspending at home, and I'm sending all my cash out to other people to buy stuff.
Exactly. When a country does that, it floods the world with its currency, the dollar, to pay for all those imports. At the same time, it's printing more debt to cover its budget shortfall. So the supply of the currency goes up while demand for it goes down. Economics 101 says the price, the exchange rate, must fall.
And that leads to this terrifying trifecta of weakness that is being flagged right now.
Yes. This is the signal. This is the flashing red light on the dashboard that tells us to pay attention.
What is it exactly?
Usually markets have a seesaw effect. If stocks drop, people run to safety, they buy U.S. bonds, or they buy the U.S. dollar.
The safe havens. When the world is scary, you buy dollars. That's been the rule my whole life.
Exactly. But right now, we are seeing stocks, bonds, and the dollar declining in tandem, together. That feels like the floor falling out. All three at once.
It is the signal that this isn't a normal correction. When all three fall, it means there is nowhere to hide in traditional U.S. assets. Investors aren't just rotating from tech stocks to utility stocks within the S&P 500.
They're leaving the building entirely.
They are stepping back and reassessing the United States as an asset class. They're saying, maybe we shouldn't have 60% of our portfolio in America. That's a huge psychological shift.
That is unsettling. It really challenges the home bias most of us have. We just assume the U.S. is the default.
And that assumption is exactly what is being challenged. This trifecta is the market saying the default setting is broken.
So if the dollar is out, or at least down, what is in? If I'm a global investor or just a nervous American looking to hedge, where am I putting my cash?
Well, the data is pointing toward a couple of, underloved currencies.
Mm-hmm.
The Japanese yen, or JPY, and the Swedish krona, SEK.
The yen. Really? It's been crushed for years. I feel like betting on the yen has been the widowmaker trade for a decade. Every year someone says, this is the year for the yen, and every year they're wrong.
That's exactly why it's interesting now. It's fundamentally undervalued. It's been beaten down for so long because the Bank of Japan kept rates at 0 while the Fed was hiking. Now that process is reversing.
The gap is closing.
The gap is closing. As the difference between U.S. rates and Japanese rates narrows, the yen has a lot of room to appreciate. It's like a coiled spring that's finally being released.
And Sweden, the krona. That feels a bit out of left field.
It's a smaller, more nimble economy, but it's well-run. It's what they call a pro-cyclical currency. When global growth picks up and the dollar is weak, currencies like the krona tend to do very well. It's a high beta play on a dollar decline.
Okay, and what about Europe, the euro?
The Eurozone is also showing some resilience, making the euro a viable alternative again. It's not necessarily that Europe is booming, but that it's cheaper and less volatile than the U.S. right now.
So it's a relative game.
It's always a relative game in currency markets. Sometimes you win just by being the least ugly house on the block. And right now, with our twin deficits and policy uncertainty, the U.S. House is starting to look a little shabby.
Fair enough. So the free lunch is over because the easy wins of just parking cash in the U.S. are gone. That is the macro picture. But I want to pivot to the micro picture. The thing hitting our listeners' wallets right now.
Taxes.
Taxes. While the dollar is sliding, we are all staring at TurboTax or sitting with our CPAs trying to figure out the one big, beautiful bill act. It was signed back on July 4, 2025.
Symbolic date.
Very. And it completely rewrites the rules for the return we are filing right now for the 2025 tax year. I've looked through the summary and it feels targeted.
That is the right word. This isn't a broad-based tax cut like 2017 where everyone just got a little something. This is incentive engineering. It's very specific about who it wants to reward.
Let's start with the headline grabbers, the stuff people are talking about at dinner parties. No tax on tips.
This is the big one. It's probably the most populist part of the bill.
I've seen the headlines, but walk me through the fine print. If I'm a waiter or a bartender or an Uber driver, is my income suddenly tax-free? Can I just ask my boss to pay me entirely in tips?
Last Nice try, but no. The IRS was definitely ready for that one. Here's how it works for the 2025 filing. There is a 100% deduction on tip income, but it is capped.
Okay, a cap. What's the number?
You could deduct up to $20,000 of tip income.
Okay, so the first $20 of tips is federally tax-free. That covers a lot of part-time workers and service staff.
It does. It's a significant boost for that segment of the workforce. But, a few key details. This federal income tax-free. You still likely owe payroll taxes, Social Security, and Medicare, unless you fall under specific exemptions, so it's not totally free money.
Got it. And there are phase-outs, I assume. It's not for everyone.
Correct. This is really designed for the working class, not the maitre d' at a five-star restaurant making six figures. If you earn over $150,000 as a single filer or $300,000 joint, you start losing that benefit. It phases out pretty quickly after that.
So it's a break for the service industry. It incentivizes people to take those jobs. What about the no tax on overtime? Is it the same idea?
Similar structure, different target. It's a deduction for overtime pay, capped at $12,500 for single filers and $25,000 for joint filers.
Okay.
But here's the compliance trap that is driving HR departments and payroll companies absolutely crazy right now. It requires employer designation on your W-2.
Meaning what? What does that mean in practice?
Meaning you can't just tell the IRS, hey, I worked 50 hours a week, so 10 hours were overtime, give me my deduction. It doesn't work that way.
No honor system.
No honor system. Your employer has to legally classify those hours as overtime under the Fair Labor Standards Act and code them separately on your tax forms. There's a new box on the W-2 just for this.
So if you're a salaried employee who just works late, a lawyer, a programmer,
You get nothing. This is for hourly workers who punch a clock. It's very specifically targeting blue-collar labor, manufacturing, logistics. It's trying to make hard work tax-advantaged.
I see the pattern emerging. It's very focused on specific types of labor. Now, the one that caught my eye, because my lease is up and I'm looking at cars, car loan interest is now deductible. This sounds like we are going back to the pre-1986 tax code.
It really does. It's a massive shift. For decades, consumer interest, other than your mortgage, has been a no-go for deductions. This changes that. You can deduct up to $10,000 of interest paid on a car loan.
$10,000? That's a lot.
It is. For the average car buyer, with interest rates where they are, that's a significant deduction. Over the life of a 5- or 6-year loan, you could easily hit that. It effectively lowers the monthly payment for tax-aware buyers.
I feel like there's a but coming. There's always a catch.
There's a huge but, a Buy American but. The deduction only applies if the vehicle has its final assembly in the United States.
So I can't buy a BMW made in Munich and deduct the interest?
No. And it gets trickier. You can't even necessarily buy a foreign brand made here unless you verify the plant. This is the really wild part. You literally have to check the VIN number.
The vehicle identification number on the dashboard.
Yes, that little metal plate. If the first digit of the VIN isn't a 1, 4, or 5, you typically won't qualify for the deduction.
Wait, what do those numbers mean?
1, 4, and 5 indicate U.S. manufacturing. If it starts with a J, that's Japan. No deduction. If it starts with a W, Germany, no deduction. 2 is Canada, 3 is Mexico, no deduction.
That is wild. It turns tax filing into a scavenger hunt at the car dealership. You're telling me that buying a Toyota Camry made in Kentucky might be deductible, but a Ford Mach-E made in Mexico isn't?
That is exactly what I'm telling you. It is entirely about the location of the labor, not the brand on the grill. It's forcing consumers to be economic nationalists with their wallets. It's a protectionist tariff disguised as a tax break.
And this ties back to that twin deficit thing we talked about, doesn't it? Trying to keep money inside the borders.
100%. The government is using the tax code to fight the trade deficit. They are effectively subsidizing you to buy American-made products to stop that flow of dollars overseas for foreign-made cars.
Okay, so we have tips, overtime, and car loans. Those are the new targeted breaks. But what about the basic structure? Did the standard deduction change? A lot of people just take that.
Yes. The OBBBA cements the legacy of the 2017 tax cuts, the TCJA. The big standard deduction that doubled back then is now permanent. For 2025, it's $15,750 for singles and $31,500 for married couples.
That is a high bar to clear if you want to itemize your deductions. You need a lot of write-offs to beat that.
It is. Most people will just take the standard, but, and this is a lifeline for our listeners in New York, California, New Jersey, those high-tax states, they raised the SALT cap.
The state and local tax deduction, this was the one capped at $10,000, which made everyone in high-tax states furious.
Correct. It was probably the most controversial part of the 2017 law for people in those states. The OBBBA raises that cap to $40,000. and it's indexed for inflation too.
Whoa, that is a 4x increase. That's not a small tweak.
It's huge. It's a game changer for a lot of households. If you are paying $20,000 in property taxes and $20,000 in state income taxes, you can now deduct all of that. That $40,000 deduction, plus your mortgage interest, plus your charitable giving. Suddenly, itemizing makes sense again for millions of people in those blue states.
It's interesting politics giving a break to blue states in a bill like this.
It is, but it also pumps money back into the domestic economy. It puts cash in the pockets of homeowners who are more likely to spend it. It's a stimulus, in a way.
And I see something here for seniors, too. Another targeted group.
Yes, a senior bonus, an extra $6,000 deduction for those over 65. It is income restricted, so it's not for wealthy retirees. But again, it's targeting a specific voting bloc, but also acknowledging that inflation hits fixed-income seniors the hardest.
Okay, so we have all these goodies. Deductions on tips, overtime, cars, a much higher SALT cap. But the government doesn't just print money. Well, they do, but they usually try to pay for things. What got the axe? Who are the losers in the OBBA?
This is the philosophical pivot we mentioned earlier. To pay for the working class incentives, the tips and overtime, the government largely repealed the green energy credits.
The EV credits, solar panels, all of it.
Gone, or significantly rolled back. The credits for buying an electric vehicle were fully repealed. The credits for home efficiency improvements, new windows, insulation, heat pumps, were repealed effective September 30, 2025.
So there was a rush to get those in under the wire last fall.
A huge rush. Contractors were booked solid. The government is basically saying, we don't care if you buy a green car, we care if you buy an American car. And we don't care if you put solar panels up, we care if you work overtime.
That is the precise ideological shift. It's moving incentives from climate behavior to labor behavior and domestic consumption.
That is a profound shift in how the economy is wired. It's a complete reversal of the policy direction from the early 2020s.
It is. And it explains why international investors are nervous. We are moving from a globalist green transition economy to an isolationist industrial labor economy. And the tax code is the weapon they are using to do it. Okay, so that's for the return we are filing right now, the 2025 taxes. But looking ahead, OBBA has some future shocks built in for 2026 and beyond. What do we need to start planning for?
The most novel concept, and probably the one that will get the most headlines next year, is the Trump accounts, also known as baby bonuses.
This sounds unique. What is a Trump account?
It is. It's a completely new savings vehicle. For babies born between 2025 and 2028, the government kicks in a one-time grant of $1,000.
$1,000 just for being born.
Into one of these new accounts, yes. But here's the powerful part. Parents and employers can also contribute up to $5,000 a year, combined, tax-free.
Like a 529 plan for college or an IRA?
Sort of, but broader. It's like a child IRA. The money grows tax-free, and there are fewer restrictions on what it can be used for down the road compared to a 529. The main constraint is that the kids can't touch it until age 18.
So it's a long-term savings plan.
Exactly. It's designed to build generational wealth, or at least a starting nest egg, for a down payment on a house or to start a business for the next generation. It's a very interesting social engineering experiment.
That is interesting. It encourages savings from birth. But again, pay-fors. There's no free lunch, as we established. I see some new taxes kicking in 2026.
Yes, and this goes back to that isolationist theme we've been hitting on. Starting in 2026, there is a 1% excise tax on money transfers to foreign locations.
Wait, like Western Union, if I send money to my family overseas?
Exactly. Western Union, wire transfers, services like Remitly. If you send $1,000 to your grandmother in Mexico or the Philippines, the government takes a $10 cut.
That seems to directly target remittance payments, people sending money back home to family abroad.
It does. It's entirely consistent with that theme of economic nationalism. They want to keep capital within the borders. Every dollar sent abroad is a dollar not spent here, in their view.
That is going to be incredibly controversial for immigrant communities. And I see another tax grab here involving gambling.
This one is sneaky. It's in the fine print. Wagering loss deductions are now limited to 90% of winnings.
Wait, explain the math on that for me. That sounds complicated.
Okay, previously, let's say you bet on sports. You win the $1,000 betting on the Super Bowl, but you also lost $1,000 on other bets throughout the year. You broke even.
Right, net zero.
So you could deduct your $1,000 in losses against your $1,000 in winnings and owe zero tax. which makes sense because you didn't actually make any money,
Correct.
right? But under the new rule, you can only deduct 90% of the losses against winnings. So you can only deduct $900 against your $1,000 win.
So I have $100 of profit on paper, even though I actually broke even, and I have to pay tax on that.
Exactly. You owe tax on that phantom $100.
Ouch. That is going to hurt the casual bettor who churns a lot of money but ends up flat or slightly down.
It absolutely will. It's a tax on churn. It effectively taxes the activity of gambling, not just the profit from it. It's a way to get revenue from a massive and growing industry.
And for high earners, I see a note here.
A final tweak. Itemized deductions are being capped for the highest bracket. The benefit is limited to 35 cents on the dollar. So even if your tax rate is 37% or higher, your deductions only save you 35%. It's a way to make sure the wealthier are still paying a certain amount, regardless of their write-offs.
So big picture on the OBBBA.
It represents a clear and decisive shift toward economic nationalism, incentivizing domestic spending like the U.S. car loans and penalizing foreign outflows like the transfer tax, a very insular tax code compared to what we've seen in the past.
Which ties right back to our first topic, the dollar. If the U.S. is turning inward, maybe the dollar isn't the global utility it used to be.
Exactly. The policy reinforces the macro trend. Why hold dollars if the U.S. is actively making it harder to trade with them and move capital in and out?
All right, speaking of market trends, we cannot ignore the elephant in the room, or rather the crashing elephant. Commodities. This week, February 2026, has been brutal for silver and gold.
Panic is the word used in all the reports. It's a washout.
Silver just crashed below $80 an ounce, down 10% in a couple of days. Gold is down too. And I'm confused. I thought gold was supposed to be the safe haven. When the world goes crazy, when the dollar is weak, you buy gold. Why is it crashing at the same time?
It's the difference between solvency and liquidity. This is a critical distinction. You have to look at the context of 2025. Last year was a record year. Silver was up 149%. Gold was up 64%.
That is a massive, massive run-up.
It was a parabolic move. What happens when you have a run like that? You get speculators, you get leverage, people borrowing money to buy more silver futures because it only goes up.
The FOMO trading. Fear of missing out.
Total FOMO. But now, with volatility spiking across all markets, brokers are issuing margin calls. They're calling up these traders and saying, your position is down. You don't have enough cash in your account to cover this bet anymore. Wire us more money now, or we sell your position.
And they don't have the cash.
They don't have the cash. So what do? They sell their winners. They sell what's liquid. They're being forced to sell.
Forced liquidation.
Yes. They aren't selling gold because they suddenly hate gold. They are selling gold because they need cash to survive. It's a liquidity crisis. And in a liquidity crisis, as they say, everything correlates to one. Everything gets sold to raise cash.
So it's not that the world suddenly decided silver is useless. It's a mechanic of the market flushing out the gamblers.
Exactly. It's a flushing out of the paper markets, the futures, the options, the leverage. The fundamental demand from jewelers or industry might still be there, but the financial layer on top of it is collapsing under its own weight.
So is the bull run over? Should people be panic selling their physical gold and silver?
I can't give advice, but the analysis suggests this isn't a fundamental collapse. It's a classic volatility event after a massive run-up. Think of it like the Bitcoin volatility we've seen so many times in the past. Assets that run up that fast see vicious profit-taking and leverage washouts. It's healthy in a painful way.
Healthy. Tell that to the guy who bought silver at $90 last week.
Fair point. It's incredibly painful for those who came in late. But for the long-term investor, this clears the froth. It resets the board for the next potential leg up.
Okay, so let's put this all together. We have a weak dollar, a new tax code that rewards Buy American, and crashing commodities clearing out the speculators. Let's talk strategy. This is the survival guide part of the deep dive.
The Great Rotation.
The sources call it the Great Rotation. The problem is clear. U.S. stocks, the S&P 500, are expensive. They're trading at 22.5 times earnings. The Magnificent 7 tech stocks are crowded, and the dollar is dropping. So where does a regular investor go?
Diversification is the answer.
Yeah.
But not just the buzzword version where you buy a few different U.S. funds. Real global diversification. It is a safety requirement now, not just a suggestion.
So we look outside the U.S. For real this time.
You have to. Look at the valuation gap. It's become a chasm. Europe and emerging markets, or EM, are trading at a 40% discount to the U.S. on average.
40%.
Yes. They are trading around 15 times earnings compared to the US's 22.5.
That is a massive spread. You're buying $1 of earnings for $15 in Europe instead of $22 in the US.
Exactly. That's a huge margin of safety.
Yeah.
And remember that currency kicker we mentioned at the top.
Break that down for me again. How does the weak dollar help me if I invest overseas?
Okay. Let's say you buy a German stock, say Siemens, in euros. For the sake of the example, let's say the stock stays flat, doesn't move an inch all year. But during that year, the US dollar drops 15% against the euro. When you sell your Siemens stock and convert those euros back into dollars, you get 15% more dollars than you started with. Your investment is effectively worth 15% more just because of the currency move.
So you win on the valuation buying cheap, and you can win on the currency conversion.
Exactly. It's a potential double tailwind. You are getting paid to leave the US market, both on valuation and on currency.
Where specifically? Europe is a big place. Are there particular spots that look good?
The sources highlight a few. Japan is interesting because their long-awaited corporate governance reforms are actually working. Companies are being more shareholder-friendly, buying back stock, increasing dividends. It's not your grandfather's stagnant Japanese market anymore.
Japan has been a value trap for so long, but it sounds like they are finally waking up.
They are. The Tokyo Stock Exchange is putting immense pressure on companies to unlock value, and Europe is attractive because the banks are cheap and dividend yields are high. You're getting paid to wait for the recovery.
In emerging markets, that always feels risky.
It is riskier, but that dynamic is powerful. Emerging markets tend to outperform when the dollar weakens. Since a lot of their government and corporate debt is priced in dollars, a weaker dollar eases their debt burdens. It gives their economies breathing room.
So it's less about them booming and more about their financial stress going down.
Precisely. The strategy noted is looking at emerging markets, specifically ex-China, or being very selective with China tech, given the political risks there.
What about bonds? If U.S. yields are falling, are bonds boring again?
Not global credit. You have to look outside the U.S., look at European corporate bonds or emerging market debt. As the Fed cuts rates, U.S. bond yields fall. That makes those foreign yields relatively more attractive. It's the same rotation logic, just applied to fixed income instead of stocks.
Okay, last big topic. We have to talk about tech. We can't ignore it. Is the AI boom a bubble? Did we miss the boat on NVIDIA?
That is the big question on everyone's mind. The consensus is it resembles the dot-com era in terms of sky-high valuations, but the spending is real. The CapEx, the capital expenditure by companies, is massive.
So it's not just vaporware and eyeballs like in 1999. Companies are actually building things.
Right. Microsoft, Google, Amazon, they are spending tens of billions of dollars a quarter building data centers. That's real economic activity. But the trade is shifting. We're entering phase 2 of the AI trade.
Phase 1 was the chip makers and the big cloud providers, right? NVIDIA, Microsoft.
Yes, the obvious names, the ones that sell the core technology. But they are expensive now. Phase 2 is about the infrastructure. It's the classic pick and shovel plays from the gold rush.
Don't buy the gold miner, sell them the tools to dig. What are the picks and shovels for AI?
Power. Number one is power. Data centers need massive, unbelievable amounts of electricity. So utility companies that are modernizing the electric grid. If you can't plug the server in, it doesn't work.
That's so unsexy. Utility stocks.
Yeah.
After chasing AI.
It's unsexy, but it's essential. You cannot have an AI revolution without a power revolution. Also, physical infrastructure, the actual buildings, the cooling systems. These servers run incredibly hot. So think about industrial REITs that specialize in data centers or the companies that build the cooling technology.
And private markets, you mentioned that.
That's a key point in the research. A lot of the really cutting-edge innovation is happening in private companies, the unicorns, that aren't public yet. The real value might be hiding there. It's harder for average investors to access, but if you have access to private credit or private equity funds, that's where the growth is.
What about smaller public companies, small caps?
That's another interesting angle. If interest rates are dropping, as the Fed is doing, smaller companies which rely on loans more than the big tech giants swimming in cash might finally catch up. They've been crushed by higher rates for years. So small caps could be a sleeper hit in 2026 as their borrowing costs come down.
So to synthesize this new world order of investing, what are the key takeaways?
It's a three-part shift. One, a weaker dollar is the new reality, so you have to hedge accordingly, and that means looking abroad. Two, the tax code now rewards domestic spending and labor, so align your financial life with that. Think about the car you buy. Track your overtime. And three, the stock market requires looking outside the U.S. borders for value.
The easy money of just buying an S&P 500 index fund and benefiting from a strong dollar, that's gone.
That decade is over. The next decade is about being nimble. It's about watching currency impacts. It's about understanding policy shifts like OBBBA and how they rewire the economy.
It sounds like active management is making a comeback. You can't just set it and forget it in an S&P index fund anymore and expect to win.
I think that's a fair assessment. You need to be paying attention. The rising tide isn't lifting all boats anymore. It's capsizing some and lifting others. You have to know which boat you're in.
Here's a provocative thought to leave you with then. We've talked about the end of the free lunch, with the U.S. debt ballooning to $33 trillion and beyond, and the tax code shifting to be more insular. Are we seeing the end of the U.S. dollar as the world's singular safe haven?
That is the multi-trillion-dollar question, isn't it?
It is. Because if the dollar loses its crown, even partially, what does your retirement portfolio actually look like in 2030? It might not be denominated entirely in dollars. You might be looking at a portfolio that holds euros and yen and maybe even some Swiss francs.
It's a sobering thought, but one worth planning for. The world is getting wider, and our portfolios need to reflect that new reality.
Indeed. We will keep tracking these shifts right here. Thanks for diving deep with us.
My pleasure. It was a great conversation.